Roth dollars are some of the most flexible dollars that you can have within a financial plan when we're looking at long-term value because they grow tax deferred, they come out tax free. So those withdrawals are tax free.
Exactly. And why is this important? There's actually a lot of reasons, and we're going to dive into them on this episode and talk about the ways that Roth can improve flexibility in your plan and be a really powerful tool to incorporate into your long-term income and tax plan. So this episode is releasing around Christmas time, and we actually are buying, or actually not buying, gifts for a child for the first time. We've got our little 9-month-old at home, and she doesn't really get gifts yet, so we are not getting her gifts.
Yeah, I don't think she can quite comprehend that. And I'd like her to understand that we're giving her something one
Yeah, we want
day.
to be the
So
hero.
she's just getting a 529, but we would do a Roth IRA if she had earned income. And it's like, well, can she be a business, a model for the business, create income for her so we can do a Roth? But
Yeah, look for her on our website in future years. She might, actually, she probably will. Right now, our website kind of has this like, oh, we definitely don't have kids kind of glam shot.
yeah, I don't know how on brand. Yeah.
Yeah, eventually I imagine that like transfers into like the classic like swinging kid photo.
That
I don't
every
think I've ever
financial
told you that,
planner
but
has on their website.
yeah,
Yep.
I feel like I've actually always imagined that, even though it is kind of cliche.
Yeah.
But I figured like we're not going to be 53 and using that same shot on our website.
Yeah.
So MJ is going to have to get paid at some point to make it on our website.
So you'll know once you see that picture, she's got a Roth IRA.
Yeah,
Unless
and
we find another way.
know that we'll have talked to our accountant about it. We'll make sure she
Mhm.
really works for it and gets an appropriate wage. So,
Yes.
so anyways, yeah, okay, that's how financial planners think about Christmas gifts. It's like, we don't need things. We just need
Tax deferred growth.
exactly. And in the case of 529s and Roth IRAs, tax-free distributions. For 529s, as long as it's for education. For Roth IRAs, provided it's in retirement. And we're going to talk all about Roth today and why it can be a really powerful tool in retirement.
Yeah, and Roth is a really unique dollar. I'm not going to say it's our favorite dollar and we're all about Roth and always do Roth conversions.
Mhm.
No, that's not the case. Although if you ask Andrew, he might say HSA and Roth are his favorite dollar. But we are just going to talk about the value it can provide, and give a couple examples and whatnot. But it's not a Roth is best all the time. It's really not. There's some high income earners that we're working with where there's a time for pre-tax.
Totally.
Especially when you're trying to manage, certain tax brackets in your accumulating years. But there is a really unique value to Roth, and so we're going to talk about that.
Yeah, absolutely. And you might be familiar with Roth, might be something that you're not familiar with, but regardless, stick with us on this because we're going to we're going to peel back layer after layer after layer. I suspect there's some things about Roth and its impacts, both in retirement and pre-retirement, that you may not be aware of. So we're going to kind of go through all the different mechanics of Roth, and then we're going to talk about a couple stories of actual clients of ours who are using Roth, in one case to live a really big life, and in another case, at least on paper or in the eyes of the IRS, to live a really small life so that they can save more on, in this case, ACA premium credits. So just give a couple concrete examples of how Roth can really enhance flexibility with the retirement, regardless of whether your goal is to go big or to stay small.
Yes, exactly.
So let's start by just giving, like an overview of Roth for someone who's not as familiar with it.
Yes. So Roth, when I think about Roth, I do think about the word flexibility. And imagine that we are nearing or we're in retirement. So all this money has grown tax-free. It will continue to grow tax-free. And if we withdraw it, it will come out tax-free. And there's certain nuances, you have to be aware of as far as tax-free withdrawals all the time, right? But the value is that tax-free growth, right? So there's two things we start to, think about as planners. The first would be, you know, when we're going to use that, right? Because if we withdraw a tax-free dollar in retirement, it's not affecting all our other income sources that may be taxed, right? And so it's not affecting the tax bracket that we're inevitably going to fall in retirement. So it's unique in that way, and we'll talk about its withdrawals. The next variable that I think about in a Roth IRA, any Roth account, is it's usually the last dollars that we're gonna touch in a plan. Not all the time, especially if we're trying to, use it if we need to go on a big trip this year, we can't affect our income or our tax bracket this year, but typically it's one of the longer term dollars. And the reason for that is it being one of those last dollars that we touch is because we wanna maximize the tax-free growth. And so if we're trying to maximize tax-free growth and it's one of the last dollars we're gonna touch in a plan sometimes, then we'd wanna put our big hitter growth stocks, right? Our more aggressive dollars in that bucket so that we can maximize the time horizon, right? Aggressive money, aggressive if we're picking stocks, we want a long time horizon so we can maximize that tax-free growth.
Yeah.
So that's how we start to think about Roth, because when you get to retirement, you have your safe money, your middle of the road money, and then some money that's still aggressive, right? And so that's how we start to place Roth within a plan.
Yeah. Yeah. And I think that like an important thing to realize with Roth is effectively any advantaged account type is going to have some type of string attached, or you give up something in order to have something else. In the case of a pre-tax account, you have RMDs, or required minimum distributions, later in life. That's the thing you give up. What you get is a tax deferral in the year that you make the contribution. The IRS doesn't just give freebies. Like, you're always going to have to give something up in order to get something. Roth, you give up the tax advantage in the year that you make the contribution. But, you mentioned, I mean, there are rules and there are strings attached. There's a 5-year rule, right? So not making withdrawals from a Roth account within 5 years of the first contribution. You can't take it out without penalty, at least the growth, before age 59 and a half. It is a retirement account. So there are rules attached. But I say this to also mention it's one of the most flexible or least numbers of strings attached in a retire or in any sort of account, really. So it's worth noting that Roth dollars don't have a required minimum distribution in most cases, whereas pre-tax dollars do, meaning the IRS is going to dictate when and how much you have to take from your pre-tax account. You are not given that same mandate with Roth. So that really does allow you to grow as long as you desire, as long as you don't want to touch those funds. Only exception is in the case that you inherit a Roth IRA from, a deceased parent or relative, in which case you do have to take required minimum distributions, but they still don't affect your income. And that's the key thing about Roth distributions. The money you take out is like, it doesn't show up as additional earned income in any capacity on your tax return. And that makes a tax planner's ears perk up, because that means there's money that can end up in your pocket that doesn't affect your income tax, and therefore doesn't affect different eligibilities for subsidies or tax brackets. So you just get a lot of flexibility.
And that even makes me think too, if you're listening to this episode and you've just been working with a CPA, and a lot of CPAs are big on pre-tax right now, a deduction right now. This might be something to think about long term if you're doing pre-tax, for the deduction. I make a lot of money, so I want to save on taxes this year, and they're sharing how much taxes you can save this year. Okay, well, we'll do pre-tax. Sometimes you want to square that up against the long-term tax burden that you might be fielding, because even if you're making less, if you have all these RMDs in the future, you're going to want to try to look at the long-term tax drag, and see if there might be some value for Roth, especially when you get into retirement, and you can't make those decisions anymore, because if everything's in pre-tax, then that's the lever you have to pull, and you have your RMD, your required minimum distribution, that you don't get to decide, and you have to take that out. So it's just, that's where Roth comes into the picture as a flexibility mechanism.
Yeah. Yeah. And I mean, what you described, it's not easy. It requires a high degree of analysis and precision with that analysis. So I call that level 10.
Mm.
We'll actually take that up to level 15 for a second and talk about, so we're talking about required minimum distributions, federal tax, state tax. There's a whole other area too that Roth can impact and help you navigate, and that's modified adjusted gross income, or MAGI.
Mm.
Or if you're in the Christmas spirit, MAGI.
Hmm.
Had to do that one. um, there are currently 9 different modified adjusted gross income calculations in the tax code. These are offshoots of your adjusted gross income, or AGI, that are used specifically to calculate eligibility or non-eligibility for various things: ACA premium tax credits, your ability to contribute to a Roth IRA, your ability to deduct a traditional IRA contribution, IRMA, or Medicare tax limits, effectively. So there are a number of ways that your MAGI is calculated, but the key thing here is that, number one, Roth IRAs don't affect your MAGI. And number two, in most cases, most other ways you might earn income do affect your MAGI. There's not a lot you can do to hide money coming in from your MAGI, unless it's coming in from a tax-free account like a health savings account, 529, or Roth IRA.
Yeah, Maggie is just one of those offshoots within the tax code where you can determine and calculate, can I, for example, add to a Roth IRA? Or maybe do I need to make a backdoor Roth IRA if I can do that contribution? So it's if you're not looking at this, sometimes it can be hard to calculate because it's your total income minus certain deductions to get to your MAGI, but it's not your adjusted gross income, or you're not able to take, for example, the standard deduction, which a lot of people think, oh, well, maybe I'll be under the income limit. So it's one of those key things to look at that determines, can I even add to a Roth IRA?
Yeah, the IRS has given us a non-intuitive waterfall and then little streams going out from the waterfall for MAGI to
Exactly. That's
to
exactly
figure it all
it.
out. But okay, so let's back down from level 15. Why do we even care about this? Let's just talk about, we'll talk just a few things in the abstract of why people might care about their MAGI and controlling their MAGI, and then talk about a couple stories where our clients are using Roth to help navigate retirement.
Yes. So the first thing that comes to mind when I think about Roth dollars, retirement, MAGI, is healthcare premiums. So the last thing that a retiree, or someone who's going to retire, the last thing they want to do is pay more in healthcare premiums. So when we're thinking about Medicare uses what's called IRMA limits, and these limits determine, if you're under, if you're over certain limits, it will determine your healthcare premium. So how much you're paying for healthcare. And they look at the last 2 years of income, of MAGI income, modified adjusted gross income. And that's going to determine how much you're going to pay for healthcare. So imagine you're retired and let's say you have an IRA and a pension, Social Security, these income sources, and a Roth. And you are already receiving some pension money, maybe you're receiving some Social Security, and it's putting you in a certain tax bracket. So what if that tax bracket is right on the IRMA limit where, if you go above, you're going to pay literally thousands more than you would if you're below that IRMA limit? Okay. This might be a situation where I'm going to tap into my Roth dollars. I've had some that are conservative. We're going to let the aggressive part of my Roth grow. So remember when I was talking about, a lot of times Roth is one of those longer term buckets that we're going to use later. This would be a situation where we would typically advise, no, let's pull from the Roth. It's okay that, we're just going to take a portion of it, but we're going to live off of that money this year because I know you want to go on that vacation to Hawaii with your family. And of course you're going to go. We're going to take from the Roth this year. So we're not going over that IRMA limit. So you're not paying thousands more in healthcare premiums than if you were to withdraw from your IRA. Or another, situation, if you're already having to withdraw from your IRA because you're forced to from an RMD and you're right on that limit, using the Roth that's where this word flexibility is going to be key. I always say that, going to be key, but it is freedom. It's freedom in retirement.
Yeah.
If you're in that situation.
Yeah, and don't miss like what you said right at the beginning too. Like this one requires more than others, actually, an extra layer of intentionality and planning, right? Because
Yeah.
at 63, if you're going on that big Hawaiian vacation, careful using your taxable or pre-tax funds for it, because that ordinary income spike 2 years before you enroll in Medicare is actually going to affect your Medicare premiums in 2 years. So that's where you do want to be mindful of year-over-year planning, particularly with Medicare premiums, as that can have multi-year impacts.
Yeah, what I just described is not as simple as I just described it.
Yeah, 100%, 100%. Okay, flip side of the coin, pre-65 healthcare, talking to all our early retirees out there. Different than IRMA, you have, for some people, eligibility for ACA premium subsidies, right? So you are buying healthcare for yourself. You're not eligible for Medicare yet. More likely than not, you're going to be on the Affordable Care Act, state exchanges to buy insurance, right? These have subsidies. They've had subsidies really since they were launched to help people afford the healthcare on it, which is maybe a different topic on healthcare affordability. But 2026 actually is an interesting year because we are returning to a stricter subsidy rule, commonly referred to as cliff subsidies. So effectively, you can get pretty decent subsidies up until 400% of the federal poverty level. And then above that, no subsidies. So as an early retiree, there are 5-digit consequences or 5-figure consequences of going a dollar over this cliff. And so that's one where you want to have options. And, if you don't use your options with intention, you can end up with a really big premium bill where the IRS comes back the next year and they say, hey, that Maggie was over 400% of the poverty level. You told us it was going to be under, and so we gave you cheaper premiums, but now we're going to give you a chargeback plus a penalty for missing the mark and not qualifying for subsidies. So this is one that's on the mind of many early retirees and is really helpful to have. Roth dollars, also health savings account. We talk about that in other episodes, but that can be a really helpful one in this situation too. Like I said earlier, the tricky thing about Maggie is that you can't really hide much from it. So even there's so many things that you have to watch for as a early retiree here, but even taxable investment accounts, if they spit off dividends or interest, none of that is hidden from the eyes of Maggie. So so you have to really make sure you're monitoring your different sources of income, as although they're making money for you, they can bite you in the butt.
A lot of people forget about that with their taxable accounts, right? These brokerage, individual, joint accounts. If they're spinning off income or if you're withdrawing income, that's included in Maggie.
Yeah. Yeah. So I mean, really, we're talking about control and flexibility, right? When we're talking about Roth.
Yes. So that is one of the key points, is that Roth is a lever you can control. So again, imagine I'm retired and I have these different sources of income, these different buckets, right? And I think about these buckets lining up, and how am I going to create my income this year if I'm trying to stay within certain tax brackets, right? So I can turn these nozzles or these levers on or off. And maybe it's a pension, maybe an annuity, maybe Social Security. Some of these levers, RMDs, IRA withdrawals, like that's going to be either a lever I can't control or just one that's creating income. Whereas the Roth, a lever, if I want to determine if I'm taking that on or off, it's a lever that doesn't push me into a higher tax bracket. And I think talking about tax bracket management is important because so even in accumulating years, right? I mean, I remember talking with a girlfriend who's also a planner, and we're talking about business owners and different clients, and tax brackets are tiered, right? So if you're in the 32% tax bracket, it doesn't mean all of your dollars are taxed at 32%. It means everything above that tier is taxed at 32%. So let's keep that in mind, because we're retired and we really want to stay below a certain tier and continue that tax bracket management. And our control sometimes can be less in retirement. If we have all these income sources that we either can't control, we have to fill up that tax bracket, we have to withdraw. So we're already filling up this tax bracket. And if we're right at that tipping point, that could be an opportunity, like I was talking about earlier, where we pull from a Roth, because if we're pulling from another bucket, we'll barely get to be able to keep that dollar, the amount of that dollar, right?
Yeah, there's some really wonky tax stuff that we could get into. So sometimes it's super non-intuitive, but sometimes, an extra $50 or $5,000 of earned income can literally be taxed into the ground because you hit little torpedoes in the tax code that suck away all of that money. So, yeah,
Yes.
it's wonky stuff, but really important stuff because no normal person is looking at their tax projections for the year and running analyses on what torpedoes they might hit in the tax code.
And it can be this cascade effect like Ben is talking about, where if you would have just pulled from Roth or, another bucket, it would allow you to keep more of your money from these other buckets that you're having to withdraw income,
Hmm.
or that you're taking money out of. And so that's that cascade effect where you need to be really intentional, because and really what's happening is this retiree just wants to go on a trip. And
Right.
so, okay, let's, this bigger expense this year, let's just pull from this bucket, and have the freedom and the flexibility and the peace of mind that you're not going to, have to owe a lot more taxes at the end of the year than you would have previously.
Yeah. Okay. So these financial planners just talked a lot of concepts, used some acronyms, hopefully explained the acronyms. We're going to finish with a couple stories of how this actually works for actual people that we work for and work with. So I'm going to talk about a story of somebody who is minimizing their life on paper on their tax return to save over $10,000 in healthcare premiums with Roth. So, and then you'll share a little bit about someone who's really more maximizing just living that like big free life because they're using Roth as a way to enhance flexibility within their plan. So when we're talking about this couple that we're working with, they're early retirees, right? So we're talking about ACA premium tax credits. And actually we're looking at this for 2026. So like real numbers, if their income is below the Maggie threshold, they pay over $10,000 less in premiums in 2026.
Healthcare premiums.
Healthcare premiums, yep. So, they have pensions. They're not yet drawing Social Security. The pensions alone fill up about 3/4 of their way to that limit, right? So we got like $20,000 of wiggle room, not a lot. Then we have to take into account taxable investment accounts, even a money market that they have that's spitting off dividends, right? So we have to really be looking, and ultimately they've just got a few $1,000s of wiggle room, and we're other topic, but we're making some shifts in investments to make sure it doesn't spit off as much taxable income. But that's where we can use the money market, we can use cash accounts, but we're touching the taxable investment with more caution and making sure, because capital gains also they don't escape the eyes of Maggie. So we want to make sure we don't realize too many gains from a taxable account.
Mm-hmm.
And really the options are using their health savings account for some medical expenses. That really helps. And then using Roth as a safety net. So as we progress towards the year and we fill up that kind of last 10-ish thousand of cap gains or dividends that they can accrue, we then turn off those buckets and then use Roth as a safety net so that they can stay under. Because, without these strategies, they weren't going to spend a ton over this Maggie limit. But if they spent even just 5,000 over it, well, then they owe 10,000 more. And it's like, oh crap. Well, it's one of those instances, right, where it's actually a negative return on the extra money that they make in a year. So
Mm-hmm.
this is a huge value lever for them to stay underneath that subsidy cliff and use Roth so that they can have more flexibility.
Mm-hmm. Yep. So much of this is when to pull income and where to pull it from
Yeah.
within the year. And that's why retirement income planning is so in-depth and important. But yes, okay, so that's an example where on paper we're trying to make someone look as small as possible. And an example of actually the opposite, where we actually were advising this pre-retiree to get big on paper. So I mean, increasing their taxable income on their tax return. So quite literally up into some of the top tiers. And so this retiree is still accumulating. And I shouldn't say retiree because pre-retiree, but we are going to retire within the next 5 years. And so, this is an example where we were actually looking at, all the wealth and trying to project, okay, what what is the income we're going to be spinning off in retirement? And his pension, there was going to be barely any wiggle room before we're in just top tax brackets for the entirety of the plan potentially. No one can say, hey, here's what tax brackets are going to be in the future, but we can look and project and see what we do know and look at historical tax rates. And ultimately his pension is quite large. So we have a lot to control. And his IRA, very large. So that also means very large RMDs, required minimum distributions. So money he's going to have to take out. Again, it's going to increase on paper his income and potentially increase his tax bracket even in retirement just by the amount that he's forced to take out. And then also receiving through the pension. So all these income sources that we're not going to have a lot of flexibility here. So on paper, for these certain amount of years pre-retirement, we did some extremely large Roth conversions. Not right for everybody. For this plan, we were converting money. We're using the after tax and 401k to do an in-plan conversion to Roth. We're doing, IRA to Roth IRA conversion. We're doing a lot to get money into Roth, right? So that 6 years from now, he will have more of a lever to pull and, creating more tax-free wealth so that that can actually grow longer and then create more flexibility in the plan. And remember that tax brackets are tiered, right? So if we project out his RMD from his IRA, remember the required amount that he's going to have to take out at one point at a certain age that, he doesn't get to determine that, the IRS does, right? And remember that tax brackets are tiered. So his pension's filling up, close to the top tax bracket. And when he's then forced to take out his RMD from his IRA, he barely gets to keep any of that money that he's taking from his IRA. So that's where we're trying to shift that. So the IRA money that we would have had to take out, shift it now, get really big on paper, put it into Roth so that, the IRS doesn't have the claim on it because we're moving it into Roth, into a tax-free space when we can control when we're going to take it out, right? And we're actually going to have a little bit of control too now with the pension. So this is where, instead of trying to keep something really small on paper, we got really big on paper these 5 years out so that the 6 year and onward, we can increase so much flexibility and choice and ultimately just keep more of our money.
Right. Yeah, this is some of that, hashtag good problems, right? Like it was a good pension, obviously then looking at Social Security later on. And then this is just saying, well, okay, because there's more guaranteed income in this plan than maybe your average plan, even small required minimum distributions or small distributions from pre-tax sources are just taxed really heavily. And so, again, these are variables that we're weighing when we're looking at a long-term tax burden and deciding, how much, like what percentage, what dollar amount of each tax allocation is most advantageous for this person. So yeah, big on paper. And then, in retirement, they desire to have kind of a bigger, flexible, jet setting, right? Retirement. So
Really fun couple.
so they're going to be able to do that and just draw from Roth because they've built up a lot of money in Roth and just really not worry about spending and worry about pursuing that flexibility that they want.
Yeah, that's the heart of this is maybe we lost you in talking about Maggie and talking about tax bracketeers, but ultimately the heart of this is for retirees to be able to enjoy retirement, not have to think about this and so hopefully this gets the wheels turning because it's trying to create long-term value which just allows people to enjoy their life and just allows them to go on the trip to, gift money to their grandkids and just not worry about it and not worry where they're pulling their income source from. But they're also not, we're not trying to tip the IRS. We're not trying to pay more for healthcare. We're not trying to, go over certain limits. And so that's where we want to marry those things so that we can enjoy life in retirement.
Right. Yep. A good plan is a great antidote for anxiety and worry about the future.
Mhm.
And if this episode resonated with you, if you're not sure what your tax strategy is in the future. If you have too much pre-tax, maybe you've got more Roth than you need for your plan. This is the bread and butter of the sorts of things that we are thinking about, talking about, projecting out, and planning for people. So you can visit our website linked in the show notes. We do a 60-minute complimentary consultation for anybody who wants to talk about their specific circumstances. So if this episode resonated with you, I invite you to go out to our website and get a call on the books.
Merry Christmas.